Good morning, traders. It is Tuesday, February the 25th. Taking a look at the charts, we're going to probably have another wild session today. Obviously, yesterday, big waterfall sell-off, bringing the SP 500 down to this recent low that we saw back here. If we look at the this low and also this other reversal low where the market intraday swung all the way down to the 20-day moving average, rallied back up. We're back down at this really critical level. Now, this is a short-term support level. If we were to just draw a line across here, you can see um, if this level is broken, things could get a little ugly. Now, I wouldn't be surprised if we saw the market dip down below it intraday and then recover. But overall, we'll have to just see how the day plays out. This is a pretty significant level, and it could be the start of something much larger depending on how things go. And if we look at the news is really starting to catch up with the coronavirus, really starting to take its toll on companies and of production and all those things. More or less, Italy is in lockdown, and there's panic food buying going on in the country. We're seeing all kinds of different companies start to warn issues of production and obviously cutting their revenue, their guidance. United Airlines really scrapped its entire 2020 profit forecast altogether. And a lot of stuff kind of just starting to fall apart because the longer this drags out, the worse things are going to get. And that's what I think we're starting to see in the markets there yesterday. Now, yesterday we did see some pretty big panic selling in the market. The VIX spiked up. We saw the NYSE. We saw panic selling on the big brand name stocks, which is generally what the masses are trading, meaning there's 15 shares being sold to every one share being bought on the ask. And when that's over 3, that's usually a short-term intraday low. When it's over 7, that's usually a significant pivot low. So we were double that yesterday. And that goes to show that we might get some follow through, some washout selling, but today, tomorrow potentially. But overall, that's usually the sign that everyone has bailed out of their positions, and we should start to see it have some type of a bounce. Now, the markets are up about 0.5% this morning, Nasdaq up 0.7%, SP 500 up 0.4%. So we're getting a tiny little bounce. We'll see what kind of volume hits the markets when 9:30 opening bell hits. If the big wave of selling hits again, I wouldn't be surprised if we see another wave of selling. More or less, yesterday was a big enough day that when people come home and they hear about it from their friends, they see it on the news, they're going to be kind of that shock and awe state where they go and they call their brokers or go online and place their orders to just sell their positions because they're scared. And so we could get hit with a wave of sell orders at the opening bell that could sell off for the morning, but we could see a recovery. So we'll just see how things go. But again, overall, things are oversold and at support. So a bounce here is likely. Now, let's take a look over at bonds. Bonds were up this morning. They've kind of been up and down, and now they're back to neutral. Overall, they've had a really nice run. If you look at this recent price action, we saw a nice run up, a nice consolidation, another run up, and more or less visually, this looks like a pretty decent move. Overall, it could go a little bit higher, but again, just like what we saw in the gold miners, when you get a rally, you get a consolidation, you get a rally, you get a consolidation. This is kind of the phase I think we are in. I think we could see equities have a little bit of a bounce, and bonds have had such a nice run that I think we're going to see those continue to kind of maybe flatline for a little bit going forward. Obviously, if we get more panic selling in the stock market that lasts more than a couple days, I think we could see bonds continue to move higher. But there was a shift yesterday where intraday wise we saw bonds, we saw precious metals really get hit midday there. Overall, they pulled back midday. Today, we're seeing them trade down. Gold now 1 point. Gold was down over 2% this morning. It has bounced back. It's down 1.5 this morning. Silver's down almost 3%. So there's definitely some big price action going on. And I talked about this resistance level yesterday, this blue line, how the last time we hit this, we saw some big bouts of selling in silver. And this is right where we were as of yesterday. And today we are seeing some more big selling step in and really kind of hammer the market. And it also hit gold miners as well. Miners most likely, let's take a peek here. Miners going to be set to open lower as well. Yesterday was a big gap up, And of course, this type of move is what we talked about in yesterday morning's video. You get a move up and then you get a consolidation. You get a move up, you get a consolidation. When when everyone's excited about gold and everyone's feeling good, that's usually when that market is more or less done and it'll fizzle out for a little while. So that's what we're waiting for. This type of reversal bar is similar to this, similar to these four that were in a row, another one like this where everyone gets all excited and then the market just needs to cool off for a bit and kind of shake things out. So perfectly normal price action. We don't really want gold miners to just rocket and go straight up, because what goes absolutely straight up usually comes straight back down. We want it to stair step its way up, rally, consolidate, rally, consolidate, rally, consolidate. This type of price action can go on for years. Something that goes parabolic will come straight back down within days or weeks, and we don't want that. We want to see a nice long steady growth that's sustainable, and we want to see miners and metals continue to rally for a long time. I'm looking over at, let me just go back over to silver here. Silver is at resistance. Again, silver has got this big formation. I do feel as though silver will be close to a huge move. I feel it feels as though it's got a lot of momentum built up behind it, that when it does break loose, I think we could see a huge run. If we go back to, on the weekly chart, back to 2010, I think it was here, I feel as though this pattern we're now on the hard right edge is very similar to what we had back here in 2010. And I think eventually silver could just pop and run, and we could see a very strong move in silver. And of course, that'll happen with gold and miners as well, but silver's got a lot of potential to really have this type of explosive move again. Again, metals have been in this beautiful basing formation. The bigger the base, the bigger the space to the upside. So all this is good. It's just we haven't fully broken into a bull market yet in miners or silver. Let's take a look over at the US dollar. UUP ETF, again, testing up near these highs, consolidating. It's still holding up really well. Obviously, it's still seen as a safe haven play. This is the weekly chart. I'm going to go back to the daily. Whoops. Here is the daily chart. Yesterday, it pulled back, and that's one of the reasons why we saw gold have a pretty strong pop initially, but overall, it is fizzling down. It's had a very strong run. Just visually, we had a nice move, a hiccup, the second half of the move. I haven't drawn a Fibonacci extension. Let's just see where we are in terms of hitting the target. It looks visually like we're pretty much there. So if we were to look at the price action for the dollar, you can see we had the run up, we had the halfway point, and then we're beyond this full 100% measured move. We've got above it, we got right up to this previous high over here, and now we're pulling back and we're trading at this 100% measured move. So we could see the dollar start to fizzle out a bit. That would help precious metals, help them hold their ground. If the dollar does start to collapse more, then we're probably going to see metals really take off. But at this point, a little bit overdone to the upside, and the dollar might have a little bit of consolidation here going forward. Looking over at energies, natural gas up 1%. Yesterday it was down about 3% and change. If we look over at the short-term chart here, you can see where we are in terms of natural gas. It kind of consolidated, got a little overbought, it sold down, and then it started to bounce again, and then it broke through the 20-day moving average with some strong momentum. It broke through a couple of previous pivot highs on the chart. If we just zoom into this chart a little bit, it's kind of squished down, but more or less you can see it broke an internal high, we broke an external high, and we broke another external high here. And you could argue this is one as well. Once you've broken two of these blue lines, typically you're in an uptrend. And you want to be above the 5-day, you want to be above the 20-day moving average. You can see the momentum, our bars went to orange, meaning we're changing from a red, which is a downtrend, to neutral, to an uptrend. The market had a little bit of a shake and fake out here. It collapsed, formed a bear flag, it's moved down. Yesterday we got these lime green bars, which lime green mean the market is now oversold. And today we're starting to see it bounce up again. And hopefully we'll get some traction and see natural gas really pop and start to move higher. We are in position for it. This type of move that we are in is just like what we saw over here and over here. And here we are again here. And each time we get in, we see the market pull back against us. Percentage-wise, it's pretty decent of a pullback each time. and of course we're having that pullback again now. Hopefully we start to see this take off just like we saw over here um, going forward. So that's what we're looking for, and we're going to just continue to hold that position as that momentum hopefully carries over to the upside and we see a big pop here. Looking over at natural gas, crude oil, it is flat on the session. It had a bounce up to this previous high to the 20-day moving average. It's been rejected and it's more or less coming back down. It's in the middle of the range, right through the tops of these candles and these wick lows over here. So overall, it's stuck in what we could look at now as somewhat of a larger range. This was the initial range we were looking at for it to break out of. Obviously, as time goes on, the moving averages move down. We originally had a target up here, but the moving average starts to choke things out and kills that upside potential. We had this little resistance level across here as well. Now you could argue we're in this bigger range. We could encompass it into this size, and we'll see how things mature through here. If they're eventually going to break to the downside, then we got $44 per barrel to the downside. If it starts to break to the upside, I'm not as big of a fan to the upside. Just there's a lot of different resistance levels. I think to the downside's got more potential for a continuation fall versus it trying to work itself up through these resistance levels and move higher. Now, one last thing to quickly cover. This video is dragging out a bit longer than normal, but take a look at the SP 500. If we take a look at this time frame here, it's had a nice run to the upside, but the SP 500 is only up about 4.5%. It was up about 10%, and the SP 500 has a way of running. Usually when it hits 10%, we see a fairly significant pullback. And we've got that. This has happened 5 or 6 times over the last several years. You hit that 10% from when a new uptrend starts and you hit 10%, the market usually has a fairly decent pullback. And so the market is up 4.62%. Now, if we were to look over at this gauge here, this is a gauge that I've been working on that'll automatically be moving with the market using our analysis, our systems. More or less, we've got our stage 1 accumulation, stage 2 markup or bull market phase. Stage 3 is more or less a topping phase in the stock market where utilities and metals start to outperform. Money starts to move into defensive asset classes. And then eventually we get into a bear market. You want to be short the market with an inverse ETF, and eventually you own bonds. Bonds during the last stages of a bear market is when bonds really take off. And then this chart in the background, this is the SP 500. This is the cycle, the life cycle of the bull market to bear market. Now, if you can take a look here, utilities and metals tend to outperform the market for a few months before the stock market rolls over. And if we were to look back at the chart, SP 500 up 4.62%. If we were to look over at utilities, it's the exact same time frame. Utilities up 12%. Definitely outperforming the SP 500. If we go look at gold miners, the GDXJ, it is up 22%. So we are seeing more or less the safe haven plays. Money is moving into these plays, these defensive plays, preparing for what could be the start of a bear market in the next couple of months. I wrote about this a long time ago, last summer, saying this is starting to take hold. We saw early signs of it then, and now we're really kind of getting that feel. And we talked about how there needs to be some type of event that's going to trigger the bear market. The market is primed and ready. It's overbought, the stock market in general. We're going on 10 years here of higher prices, and all we need is some type of event. We didn't know what it's going to be, but it looks like it could be the coronavirus, could be the thing that tips the scale, where it's going to affect all kinds of company earnings. It's going to just start crashing down, countries start closing their borders, and this could be what triggers the next bear market. And I know a lot of people are thinking it's going to be some type of financial collapse, currency, a country going bankrupt, whatever. We never know what it's going to be, but it could end up being the coronavirus that could create a domino effect of all kinds of new issues going forward in the financial sector. So overall, that's where we are in terms of kind of this cycle. It looks and feels as though we're in this defensive phase. We're still in a bull market. That's why the chart here is still green, but money is moving over into these safe haven plays because no matter what, we still need utilities, and people want to own metals and miners simply because they are an asset that should rocket higher during fear. And metals in general, especially physical metals, acts as a currency no matter what happens with the US dollar or whatever foreign currency people are holding in. So anyways, that's it for this morning. Talk to you in a bit. Bye-bye.